Financials led the recovery on the Lal Street on Friday, which helped the markets end a volatile session at the flat line. For the week, the Nifty and the Sensex snapped its 3-week losing streak to end in the green. On this week's episode of Editors Roundtable, we put the spotlight on what to expect from the Q2 earnings, which is the big Q next week. We'll tell you why theme-based funds are back in vogue, and we'll take stock of how outflows from emerging markets are slowing down. I'm Sonia Shanoy, and with me I have Anuj, Prashant, Nimesh, all the editors here on the roundtable. Folks, it's been an interesting week, ups and downs, and a lot of big Qs starting from next week given the Q2 earnings. So lots to reckon with.
Yeah, lots to reckon with, and rains in October, so it's crazy sort of weather and crazy market.
Yeah.
Sonia, this is not the market in which you can take a unidirectional call, because if you do that, the market's just going to make a mincemeat of you. And I think just respect the screen, keep changing your positions, keep changing your stance. And this is the kind of a market in which you take quick singles instead of trying to hit big sixes and trying to hit them all the out of the park. Just take quick singles here or there, and the full toss will come. Then try to despise that for six. That's what I would say.
He's talking about full toss, but he's actually hit a full toss, joining as a managing editor of Avas. So which is actually forget markets, forget stock moves, whatever. I think the biggest news for this week, to me personally, was he's joining as a managing editor of Avas, which is a big thing for the entire team who's been with him for last 20 years.
I'm still waiting for the party. I'm still waiting for the party.
इसीलिए हम इस तो अगला आधा घंटा हिंदी में बात करेंगे.
अच्छा. सिर्फ पार्टी मिलने के बाद.
Anuj, it's up to you.
Absolutely privileged, Prashant, Sonia, and Nimesh, and of course I'm still part of this team.
Of course.
That just goes to show how much life changes, right? Yeah. Last week when we were sitting on Editors Roundtable, it was a different situation. Same with the markets, right? I mean, things change on a dime.
Absolutely. Actually, this week, I mean, to come back to the markets, we missed the single best day, right? Yeah. Wednesday was a market holiday. Tuesday, US market was up, what, 3.5%.
But still for the week, Prashant, S&P is up 6%, India is up almost 3.5–4%. Yeah. So we've recovered from the lows, for what we saw. I mean, last week, same time, everything was like looking so bad. We were like, oh, S&P is hitting a new low. It's going to go below 52-week low and all. And everybody was a little scared, right? As I said, there was a lot of fear in the market as well last week when you spoke about it. Yeah. So much of fear in the market. So I think that's changed now.
I think the big question for me, and I'm sure for every investor, is whether the worst of the bear phase now is behind us. And is this market, getting into Diwali mood? Is the uptrend going to resume itself in a big way? Anuj, what do you feel?
Sonia, this week saw the return of algo trade. For me, the big highlight was what was happening with crude and dollar rupee, because I think that was important. Currency and crude at play. In fact, the dollar rupee breached 82 half, and this happened without the dollar index actually going back to previous peak. Because earlier what was happening was that while dollar was getting stronger and that's why rupee was falling, but at least rupee was outperforming against other currencies. This week that sort of changed. Now, is that an early indicator? Because sometimes money market is ahead of equity markets. Actually, every time the money market is ahead of equity market. So, is that the case? Look at what happened sectorally. Despite the comeback, the Nifty Bank this week was up only 0.6%, or actually by the end, because of the recovery, almost 1%. But the Nifty IT was up over 3%. And this, I think, my sense is again the tactical trade which is playing out just ahead of the earnings season, where some money moves to IT because of this currency factor. So I think that's something which played out. The other street sign which I picked up this week was that the broader market outperformed. The mid cap and small cap indices ended well over 2% this week. And early days yet, only 4 days in this month so far. But the market breadth that we have this time round is the strongest that we've seen. 1.6 to 1 on average. In the month of September, it was 1. And post-COVID, we haven't had this healthy market breadth. So I think that's something that I'll keep an eye on. The one sort of negative sign is if you are tracking valuation. Because if you look at the sectors, most of the big sectors are now trading above median valuations. In fact, banking is the only sector which is now trading below its averages. I have the numbers with me, and this is courtesy CLSA. If you look at the premiums, the banks are actually trading at 7.5% discount over a 5-year period and 9% discount over the 10-year average. Look at others. IT, the premium is down to 3% over a 5-year period, and that's why a lot of people believe maybe IT has bottomed out. But over a 10-year period, still trading at 16% premium. FMCG, 13% and 16% premium. Autos are trading at 26% premium now compared to their 10-year averages. So, my sense is that that perhaps could be one factor which could play out. A lot of outperformance of Indian market and resilience has meant that the market has become extremely expensive if you look at the overall combined market individual sectors. But Nimesh, what did you pick up from the dealing room?
So, Anuj, this was not a week of big FI buying or a large institutional support. It was more of a tactical pullback. And that's exactly what CLS had put out last week, right? That the S&P was at a level where from which in the previous instances, the S&P has rallied 17-18% purely on short covering rallies and pullback rallies. That played out to some extent in S&P this week, was up 6%, and that helps the Indian market as well. So even we are up some 4%, but there was no large participation from the larger institutions, both FIs and TIs. Even the retail investor seems to be pretty much on the sidelines. There is a bit of fear as well as to how much we can go down from here, and hence not much of participation coming in. I guess technically we are pretty close to the first resistance of 17,400. That's taken out maybe 17,600, 17,800, 17,700 is what our dealers are talking about. Could be the next level to watch. But I guess for India markets, my sense is the focus will shift from the macros to the micros as we head into the earnings season. We will see all the large technology names putting out the numbers next week, and that's going to set the tone for the earnings season and for the individual companies as well. So that's something to watch out for. I guess the big joker in the pack from here would be the crude. Even Prashant has been pointing out of late that the crude is bouncing back from the lows, and that could really hurt the India macros. That's going to be a big worry point, so to speak, for the Indian markets, at least in the near term. So that's something to watch out for. But broadly, as I said, it was more of a tactical pullback, a technical pullback, so to speak, both in S&P as in for the Indian markets.
Just to pick up on that point, Nimesh, I presented this EPFR data earlier as well, about 2 or 3 weeks back. So this is data, this is weekly data which EPFR puts out, and the numbers are actually pretty interesting. So they track data for all kinds of funds. We're obviously interested only in emerging market funds. That's the fund group through which we get most of our foreign portfolio investments. 94% of it comes through EM funds as a category. So what did we see for the week ended October 5th? Outflows again, but far lesser outflows. $1 billion went out of EM funds in the latest week. The prior week, that number was 2.3 billion in terms of outflows. So EM funds have lost money for 8 weeks in a row. This is the longest stretch that we've seen outflows in one go since the onset of pandemic, which was from the April-March 2020 time. 8 weeks outflows from EM funds, but the outflows are now slowing down. It's not a trickle. $1 billion is still a large number, but it is down quite a bit. Now, where are the outflows coming from? This is in terms of active versus ETFs. A couple of weeks back, ETFs were losing money. That is not the case now. ETFs are actually getting money. So for the latest week, ETFs took in $671 million. Active funds lost about $1.7 billion or so. In terms of, what kind of funds, so there are two categories. There are global emerging market funds, and then there are regional funds, which is, an India fund or a Korea fund. As I said, bulk of the money comes from EM funds for India, not from regional funds. So that's a bigger lot. So global emerging market funds is where we saw the maximum outflow. Out of the $1 billion outflow, the total $1 billion outflow, $900 billion left global emerging market funds, which means that regional funds, it was a very small number. Now, I'm going to leave you with a thought. Jonathan Garner of Morgan Stanley recently put out a report essentially saying, are we at a point where emerging markets as an asset class is bottoming out? Are we close to it? That's interesting. So let's just put the data out. Our EMs at a turning point, the last one. So there are just two sets. The average the average number of days that MSCI emerging market as an index has taken from high to low in terms of a bear market is 263 days. This is 10 instances from 1997 to year 2000. And the fall, consequently, the average fall is 38%. The current episode, the current peak, the last peak, the episode we're talking about, the peak was in Feb of 2021. In this particular case, and it's continuing right now, we've been down for 590 days. And the drawdown, the loss has been of almost 40%. And I think, questions are being asked whether this is it and maybe things start to turn around a little bit. The implication for India is simply that if the basket of emerging markets starts to trough out and starts to move higher, it means that EM funds may start to get money. India has done far better than most other emerging market peers, even within the MSCI emerging market index. But if the category starts doing well, more money gets allocated to this category and India gets its 10-12% share. That's the whole point of it. So something to watch keenly. But Sonia, in terms of local fund action. There is a lot going on. NFOs, thematic funds, what's going on?
Absolutely. So I think, this is the market where thematic funds have come back in vogue, right? So we had a lot of that this week, and I wanted to talk about it in detail, but let me just go straight to the big wall. Now, in the last fortnight, a lot of fund houses have launched theme-based funds. So we're going to just put a little bit of focus on that. We start off with Kotak that launched a business cycle fund where they will dynamically rotate portfolios within different sectors. But the two funds that interest me, the NFOs, were one was ICICI Pru, which launched a transportation and logistics fund. And IDFC as well launched the same fund, a transportation and logistic fund, where they're talking about autos, auto components, logistics, and rapid urbanization, which is accelerating growth in the transportation industry. All right, so let's focus on this theme itself, the transportation and logistics theme, and we've already seen big moves come in individual stocks here. Now, here's the story, right? India's per capita income is definitely on the rise. There is a room for rise in discretionary spends as well. There is premiumization that everyone is talking about. And the average salary has gone up by 23.5% in 2022 after lying flat for the last many weeks and months. Now, just look at this graph. Right, for the last about 10 years or so, we've seen the rise in average salary anywhere between about 6% all the way to 12.5%. In 2022, India Inc.'s average salary rose 23.5%. Maybe not yours and mine, but definitely on an average, right, the salary has gone up. Now, this is, of course, we're talking about individuals, but if you look at the per capita GDP, right, it was in FY22 about, it's expected to rise from about $663 billion in FY05 all the way to 4,891. So that is what we're looking at in terms of the per capita GDP. And if you look at the auto penetration, right, that's the big theme that everyone's talking about. Now, the number of cars per 1,000 persons, and this is, of course, not an apples-to-apples comparison because it's very different for developed countries, but India has only 24 cars per 1,000 people compared to any developed market that you look at, whether it's China, USA, UK, all are much higher than about 100. So this just goes to show that there could perhaps be, some more growth opportunities here. Number of two-wheelers as well. This is, of course, not cars, but this is number of two-wheelers. That as well is, there's a big penetration story over there. Now we'll go to the logistics market. There's a structural story there emerging in the logistics market. India's logistics market currently is at $216 billion, and only 3.5% of this is for organized players. So the story here is that there will be a big move from the unorganized to the organized market, and hence the logistic market will grow in size. In FY20, the size of the logistic market is $216 billion. It's expected to grow all the way to $365 billion by FY26. At the cusp of a turnaround is the auto sector. So, of course, there are plenty of stocks that you'd look at over here, whether it's M&M, whether it's Tata Motors. But, just if you drill it down, there's the auto ancillary space, there's the whole logistics theme, and that's why there are many NFOs that we're seeing in this space. Back to you guys.
All right, Sonia, thank you very much for that. It's very interesting. Lots of niche funds coming up, lots of activity, lots of interest there. What we'll do is, guys, we'll take a quick break here. We'll come back. Nimish is going to go onto the wall and present some data in terms of what we should expect from Q2 earnings season. And then we'll have Ashwini Agarwal also join us from Demeter Advisors on the other side for some market conversation. Stay with us.
Welcome back to the Editors Roundtable. Well, we have, of course, we've been talking about the markets in the week gone by, but let's tell you what to expect in the week to come. Q2 earnings will be the big talking point, and Nimesh has walked across to the big wall to tell us what to expect this time around. Nimesh.
Well, Sonia, it's going to be very, very hectic for the next 4 weeks for us as we look at the earnings season. And, look at the calendar for next week itself. It's going to be a hectic next week to start with TCS on October 10th. Then we have Delta on October 11th, HCL Tech and Wipro, both from IT on October 12th. We have Infosys and Mindtree on 13th. We have Bajaj Auto and Tata Elxsi on 14th. And even on a Saturday, it's going to be very hectic with Avenue Supermart, HDFC Bank, ICICI Pru Life and L&T Infotech all reporting on the 15th. So it's going to be quite hectic to start with the next week. Now, I've just looked at the overall earnings preview of a lot of the brokerages. So here's the summary of Q2. The potential leaders are going to come from BFSI, consumers and autos. They are expected to report strong numbers, whereas laggards is going to be from metals and oil and gas. They are going to disappoint. So I've looked at the individual sectors now. The first is technology, because they are going to start first. It's going to be a mixed bag for technology, but it's not going to have a big impact on the FY23 and FY24 EPS estimates. That's the overall consensus. The growth may slow down in FY24 estimates, but it appears to be priced in, so there's not going to be a big scare. However, the risk is the recession, the deep recession in US and Europe. So that's for the IT sector. Now coming to the banks, because that's a big sector. Within the banking sector, I think the big theme is the credit growth and NIMs are showing resilience and liabilities are gaining focus. But the biggest surprise in terms of positive surprise will come in the private banks. The PAT growth, the analysts are expecting a 53% growth YOY. So that's on private banks. On NBFCs, the growth is picking up. So even there's going to be no big negative surprise. Even for housing finance companies, there's going to be a strong individual disbursement for the HFC. So that's going to be clean. And for the insurance companies, there's going to be some moderation in terms of the VNB margins compared to the Q1. So there's going to be a small disappointment on the insurance. Coming to the auto sector now, again, that's going to be a big sector and it's going to outperform. So sequentially, it's going to be an improvement in the margins. Q3 is going to be the best quarter in terms of recovery from the input cost, which was hitting them. So CLS has put out a note, and they believe that in Q2, the biggest EBITDA, highest EBITDA margins will come for Ashok Leyland and Maruti. So they too are going to outperform as far as the autos are concerned. Now coming to the cement sector, it's going to be a washout sector for cement in Q2, but that looks like it's in the price. So the profitability will be at a multi-quarter low in Q2 for most of the cement companies. In fact, Street is expecting the EBITDA per ton to fall by 50% YOY in Q2. Expect margins to recover only from Q3. But again, it looks like to some extent it's in the price. Now coming to the telecom sector, it looks like it's a stable quarter for telecom, limited surprises. 5G is going to be the next big trigger. For Bharti Airtel, it's going to be a slight increase in the ARPU. But for Vodafone India and Indus Tower, that's going to be a tepid quarter. So that's going to be for telecom. Now looking at the paint sector, that's going to again report a very strong quarter according to the brokerage. So the demand is quite buoyant. There is a festive cheer as well. And Macquarie believes that Asian Paints is going to lead the paint sector. So that's with the paints preview. If you look at the fintech companies, now I picked up for a specific reason. It's going to be a steady quarter for fintech companies. Paytm across the board, there's going to be a good momentum. For PB Fintech, again, sustained growth. But for all these companies, the lock-in opens in November, and that's going to be a big overhang for all these stocks. So fintech largely on the lock-in overhang will be key to watch out. So as I said, it's going to be a mixed quarter for Q2. No big surprises, but I guess individual sectors will be very important as far as reactions are concerned.
All right, Nimesh, thanks very much. That's very exhaustive and very interesting, especially the last fintech bit. Ashwini Agarwal is now joining us. He's founder and partner at Demeter Advisors. He's in our studios. Ashwini, great to have you with us here.
Thank you. Thank you for having
me. In this
over.
unseasonal rain. You weathered the rain, and so thank you again. How are things looking, Ashwini? You've been a bit cautious overall because of valuations and where they've been.
Yeah.
Are you still a little apprehensive of how far this can go?
Yes, because the world is in a very uncertain place. Earlier this week, for example, everybody is expecting the US Fed to pivot, but there is no sign of that happening. I think the risks have increased with oil prices going up. So the world is in a very, very uncertain place. And as to what Nimesh was alluding to earlier, the focus is going to be on quarterly earnings next week onwards. And I expect the earnings to be not as good as what the market is hoping for. And I would focus a lot more on the commentary than the numbers themselves. And I think the commentary could be a little soft because at the margin, I see demand trends softening, both export-led as well as domestic. So I am a little cautious. I continue to be a little cautious. Obviously, one is hoping that one doesn't have a big accident either in India or anywhere else in the world because of the different forces that are pulling us apart as a market. But even if an accident doesn't happen, I see very limited room for a broad-based upside from here.
So would you extend that caution to sectors like, say, IT? Because the writing is on the wall, right? I mean, there are margin pressures. Perhaps heading into a recession, there could be a crunch in client spends as well.
Yeah.
Do you think the worst is in the price, or could there be more to go?
I think a lot of the bad news is in the price. So that's one area where, I've been struggling with, where, I've been negative for a while. Stock prices have come off. These are best of breed companies in terms of governance, in terms of cash conversion, in terms of dividend yields. So at some point, they'll become a buy. Now, whether it's 5% down from here, 10% down from here, I can't say. But this is an area where I would be looking at the earnings very, very closely, at the commentary very, very closely, And if companies are confident about the next few quarters and coming through without too much of a trouble, I think there would be a buy. So that's one area where I'm looking for an opportunity to invest. Not right away, but maybe 5-10% lower.
Okay, Ashwini, good evening. What's happening with the liquidity front? Because our market has been supported a lot by domestic liquidity. I mean, if this was a market of 2008, it would have collapsed, right? But the domestic fund sort of prevented that. The FI money is coming, but it's not coming in the kind of numbers that we used to see. It's
That's
still,
right.
On and off.
That's right.
What's happening here?
Well, we are a closed box market, right? Most of us can't take out much of our money outside. So we are, forced to invest in the local market. And if you look at the size of the household savings, and even if you were to make very, very small allocation assumptions towards equities, you can easily make a case that $2 to $3 billion every month can continue to flow into India. And that's really India's story from a downside protection point of view. So I don't see that changing. The other thing is that most investors have now realized that via mutual funds or even via direct equities, if you're willing to look past speed bumps, this is an asset class that gives you great returns. Over the last 20 years, it might have been 18 to 20%. Over the next 20 years, it might be just 10 or 12%, but 10 or 12% is still much better than 5 or 6% that you would get in any alternative fixed income securities. So my sense is that this allocation towards equities will continue unless there is something that causes everybody to become very scared. And that would be an accident, of the sort last weekend, for example, there were a whole bunch of these news articles about a large Swiss bank, Credit Suisse. If something along those lines happens, then all bets are off. Then, you will go through, one big sort of a scared sell-off, a scary sell-off. But that would be, again, an opportunity to buy. And that's what people have realized, that, whoever bought in the COVID fall made pots of money, and that's why those steep falls don't happen.
Ashwini, what about financials? Because even as I pointed out, that's one space which is in the sweet spot.
Yeah.
The private banks are going to report 30% of 30-35% YOY PAT growth. What's your view on the financials now?
I think great place to be across the board, because you're coming out of a 10-year slow cycle. So economy is expanding. Inflation is helping credit growth. There is working capital expansion that has happened because businesses started to grow, companies are willing to invest. So my sense is credit growth, asset quality, margins, everything is at a sweet spot. And again, it's a question of what happens to rates. I think, we will just muddle through with maybe 25 basis points here or there on the 10-year government yields. So if that assumption holds true, you don't have much of a downside on the fixed income book either. Sure. So there's really nothing to not like about the banks at this point in time. So that's one area where, I think one should be very, very positive.
I think Anuj pointed out that data, right? The only large group, financials, down 16% from its 10-year
has a discount compared to its 10-year average.
That's right. The value is still there in the sector.
Okay, well, that's what we want to know. I guess that's what our viewers want to know. But in case we don't speak before Diwali, greetings of the season to you.
Same to you and to your viewers.
This has been a good one, right, for everyone. Yes. As you said, people who had invested in the COVID dip would have made pots of money. I hope they continue to do so. With that, though, it's a wrap on this edition of Editors Roundtable. Thanks a lot for watching, and you folks have a great weekend.